Hi guys, I trust you are doing great and that all is well with you. And I hope you've eaten. Yeah, if you've eaten, that is a good job. But if you've not eaten, Charlie, get something and eat. Why? It's very necessary. Your health matters. So take very good care of your health and most importantly, stay safe because I did for you. So that was just by the way. My name is BY Samuel. If you are new here, then I welcome you to the BY class, where we make fundamental and complex lessons very simple and easy to understand. So stay tuned because we have a lot in store for you. So today's lesson we'll be looking at accounting equation. We'll be looking at accounting equations. Yes, so that will be our topic for today, and at the end our main objectives is that you will be able to understand what it means to be said or what it means to call something an asset in business. Also, what liabilities are, what is capital, and then most importantly, what the accounting equation really is. So stay tuned and don't move anywhere. Get your pens or your books ready and let's get started on rewriting the stars. So to begin with, we talk about asset first and we say what is asset. So assets are economic resources that provide potential future services to the organization. Assets are economic resources that provide potential future services to the organization. So what's the fundamental understanding or the fundamental definition for what assets are is basically the things that are owned by a business, the things that belongs to a business, or the things that helps the business to run. So anything that belongs to the business or a business or an organization is referred to as an asset. Anything that belongs to an organization or anything that is in an organization that helps in the running of the organization is referred to as an asset. Okay, anything that is in an organization that helps in the efficient running of the business is referred to as an asset. So it helps to provide potential future services to the organization. So yes, that is what is meant to be called an asset. And we have types or categories of assets, and we have two main types of assets. We have fixed assets or non-current assets, and then we have current assets. But we will tackle the fixed or non-current first. So when we talk of fixed or non-current assets, they are acquired not for resale, but to help in the running of the business. So these assets are the things that are in the company or the things that are in the organization that we use them in the daily production of goods and services in the organization, meaning they help in the running of the organization, but they are not basically for sale. Okay, they help in the basic running of the business. So that means without these resources or without these equipment, the business cannot be able to run. So because of the types of or the nature of these type of equipment or resources, we've grouped them into two parts. We have ones that we can see and touch, which forms the tangible aspect of the fixed asset, and then we have ones that we cannot see and touch, and those ones too forms the intangible aspect of the fixed asset. So let's take examples so that I get the better understanding of what it means to be called an asset. So when we take the tangible fixed assets, they are the parts that can be seen and then touched. So an example is like land and building. So the land on which the business organization is set up on, and then the building in which the activities of the business or the activities of the organization is taking place. You see, the building is not for sale. It's not for sale. So is the land. The land is also not for sale. So in this case, Both the building and the land are helping the organization to achieve its aim or to be able to what, work efficiently, but they are not for sold. And these two things too, they belong to the business. So because they are not for sold, they are not for sale, and then they help in the efficient running of the business, we call them fixed assets because they are in the business for a long period of time. We are not selling it. We are not giving it out. They are just within the business, and it's helping us to be what, if able to run the business efficiently. So those are the things we term as fixed assets. Another example is machinery. Machinery is maybe the big equipment they use in the production. So these equipments are also not for sale. Hey, why am I saying for sale like that? Abi, I'm telling you, go and find something to eat. But me myself, I've not eaten, so pardon me. So let's continue. So the machinery within the organization is also not what, for sale, but then it helps in the running of the business. It helps in the production process. So because of that, it is also known as fixed asset. But then the tangible aspect, because we can see it and we can touch it as well. Another example given here is the furniture. Furniture is also the seats or the chairs and tables we use within the organization. And these ones too are not for sale. They are not for sale because we just sit on them to, be able to what, feel the comfort in the workplace. So they are also not for sale, but they also help in the production or in the efficient running of the business. I hope these examples are making sense. Motor vehicle, maybe we go to purchase an item and then we want to transport these items to the business. We use the motor vehicle or what we call the van. But we are using motor vehicle, so motor vehicle. So they also help in transport services, but they are not also what, for sale. So those are the tangible fixed assets. Fixed because they do not they they are within the organization for a longer period and they are basically not for sale. Are you getting it? Now let's come to the intangible aspect of the fixed asset. So just as the name says, intangible, for them they are materials that also exist, but then we cannot see, neither can we what, touch. They do not exist in material nature, but then they are services that are provided for the business for a longer period of time. So something like copyright, the right which helps a business to be the sole owner of a particular brand or of a particular product, is called copyright. So this copyright too, you realize that when the company goes to make or sign up for a copyright of a particular brand name or some logo or any other thing relating to let's say a badge or a logo or the brand name. So the company going to sign up for that, is requesting that the government or the law would protect the company's product for a longer period of time. And this copyright, it is not that we are selling the copyright. We can't sell copyright after all. I get it. But then it also helps the business to prevent you know, illegal copying of the business's intellectual property. You get it? So that is what is termed as the intangible fixed assets. They are also not for sale, but they help in the what? The running of the business, prevent illegal copying of intellectual property. So goodwill. Goodwill is, let's say you have a name, let's say a brand name, which is very popular. So something like Adidas. Adidas is a very popular name. And you want to also create or venture into production, and you want Adidas to kind of give you a part of the name, as in you can place the name Adidas on your what we call on your products, or you can also name your institution Adidas. So when they give you that goodwill, Adidas is already having the market. It's already having the name. Everybody knows Adidas, that kind of stuff. Yes. So the goodwill here is that when you place the Adidas on your organization, you realize that because it is a well-known brand, you it's very easy for you to attract a new market. It's very easy for you to get to new markets or larger markets. So because of that, Adidas is going to give you a goodwill, and which you are, yeah, definitely you pay for it. So it's going to give it to you in business management or in business administration. There is something we call a franchise. So it's more like a franchise kind of thing. So these things are also goodwill, copyright, trademark, leasehold. They are all fixed assets. They are within the business and they are owned by the business, but they are not to be sold within the business, or they are not basically for sale. I hope this is very clear. And now let's move on to the second type of asset, which is the current asset. Just as the name sounds, current assets. So basically, these ones, they are to be converted into cash within a financial year. They are to be converted or expected to be converted to cash within a financial year. So let's say the business is into the production of beverages, drinks, okay? And then the drinks within the organization are also owned by the business. Is that not it? Yes, they are owned by the business. But these ones are to be sold out. Okay. So when we sell it out, the only thing that we get in exchange is the cash. So within a financial year or within a particular period, we are expecting or we are all anticipating that we'll be able to sell all the beverages or all the drinks within the organization, because it is not the drinks that we are interested in. Okay, we are interested in the cash, but it is drinks that we have, so we can only give out the drinks in order to what get the cash. So anything within the organization that is what is expected or can be converted into cash within a financial year. That means you shouldn't go beyond one financial year. So within a financial year is what we term as a current asset. Okay, it's what it's called a current asset. So examples include stock. Stock basically refers to the things that the business is selling, or the thing the business is selling or dealing in. So if it's a service, the services that the business is providing. So it is expected to be converted within a financial year. Debtors, those who are owing us, if we record their names in our books, it is not their names that we need, but then it is the monies that they will be giving us or they are owing us that we need. So we do record debtors as a current asset, because definitely when we write their names as people owing us within the organization, within a financial year, we are expecting that they come and pay us back our monies. Okay, they come and pay us back our money. So that is why debtors or people who are owing the business are also referred to as current assets. They also refer to as current asset, because if when the time they came to purchase the items, if they had given us the money, we wouldn't write their names at all. We would just write the cash in which they've given us. Okay. And we have bank. Bank also, the check. The check can be converted into cash within a financial year. The check can be converted into cash within a financial year. So any transaction that has bank in it is referred to as a current asset. Cash itself is what we need. So cash itself is our current asset. The monies or the cash that is within the organization is referred to as what? A current asset. Bills receivable. All bills, all monies that we are expecting to receive, all monies that we are expecting to receive, they are all current assets, because that is what the business have. I hope this is very clear. Let's move on to liabilities. Liabilities. So they are financial obligations that the organization must pay to other parties. They are financial obligations that the organization must pay to other parties. So in this case, we are looking at the financial obligation that we, the business, must what fulfill to other parties. So let's pick examples. I don't want to go faster than the slides. So with liabilities too, we have, just as we have two types of assets, we also have two types of liabilities. We have the current liability, just like how we have current assets. So if current assets was expected to be converted into cash within a financial year, current liabilities also expected to be paid within one financial year. So with assets, we were expecting those monies, but then with liabilities, we are supposed to pay those monies within the financial year. Within the financial year. So examples include creditors. Creditors. So the creditors are the people that sell to us on credit. That means we went to buy or we went to purchase items from them without paying. So because we went to purchase from them without paying, they are expecting that within a financial year, we come and fulfill that payment. We come and give their monies back to them. So those things are also referred to as what? Current liabilities. Current liabilities. We have bills payable. All bills that we are supposed to pay to other parties are also referred to as current liabilities. All expenses owings, or we are owing a lot of expenses, or we are owing small expenses, or we are owing moderate expenses. The very moment is an expense and then we've not paid for it, that means we are expected to pay. So if we are expected to pay, then it becomes a current liability. I hope this is very clear. Let's move on to long-term liability. So if we are comparing long-term the liabilities to assets, then the long-term liability is going to act like fixed asset. It's going to act like fixed asset. So usually debts that fall due beyond one financial year are what we term as long-term liabilities. So these particular items, they are also, we are expected to pay for them. Okay, we are expected to pay for them, but it is not necessarily within 1 year. So that means they are expecting us to pay those monies, or they are expecting us to fulfill those obligations, but it is not necessarily within 1 year. So it goes beyond a year. So like 2 years we can pay for that debt, like 3 years we can pay for that debt, like 4 years we can pay for that debt. So those ones are what we call long term. So just as the name sounds, long term, we are expected to pay, but not necessarily within a year. It goes beyond a year. I hope this is clear. So an example is like going for a loan from a bank. So the loan here is expected to be paid always not within a year. It sometimes goes beyond a year. Debentures too is also referred to as a long-term liability. I hope this is very clear and easy to comprehend. Charlie, accounting is very easy. Oh. Learn it and be free. So we come to capital. So what is capital? So we were made to understand that the total resources supplied to the business by its owner is referred to as capital. Because the business didn't just come on its own and got the land and got the furnitures and got the equipment and got the building, and then it came on its own as a business. No, the business is not God. The business is not a magician. It is someone who set up the business. But there is one rule in accounting, or there is one rule in business that says that business has a separate legal entity. And what this rule means is that the business is separate from its owner. The business is separate from its what? Its owner. So because the business is separate from its owner, anything that the owner would introduce or would think of adding to set up a business becomes the capital. Anything that the owner introduces into the business becomes a capital. So the land was purchased or bought by the owner. So the very moment the land is now a business land, it is called capital. Are you getting it? It is what? It is a capital which was raised by the owner. But then in the business, it is known as an asset. So the land is what? A capital raised by the owner. But then within the business, it is is an asset of the business, because now it is no longer in the hands of the owner. It has become part of the business. So when the owner introduces the item into the business, it becomes it becomes a property of the business and no longer the owner's property. So, capital is referring to all the resources that the owner brings to start up a business or to set up a business. I hope this is very clear. And it is sometimes also called owner's equity. Owner's equity. So kindly take note. So now, something in addition to capital, we have what we call net profit. The net profit. So the net profit refers to surplus or excess monies that remain after all expenses are deducted from total revenue. So all the monies, all the sales that we make. So let's say the example I give in the initial start, the business is into the production of beverages. So when we sell all the beverages within the organization, the money that we get is called revenue. So when we sell all the things that we are supposed to sell or all the stock we have, when we are able to sell it, the money we get is what we call the revenue. Now, when we take out all the expenses we've made within that particular period, when we take all those expenses out of this revenue, the remaining money left is what we call the net profit. Is what we call the net profit. And this net profit, it doesn't belong to the business. It belongs to the owner because the owner is interested in what's the profit. Are we getting it? So the net profit refers to all the remaining monies that's come after all expenses are subtracted or deducted from the total revenue. I hope this is very clear. And then the last but one thing we'll be talking about here would be drawings. Now, because the owner introduced money into the business and it became a property of the business and no longer in the hands of the owner, when the owner is coming to take something out of the business, we record it as a drawings. That means the owner has come to reduce the initial money he introduced as capital into the business. So let's say the owner brought 1,000 Ghana cedis as capital for the business. And during the operation or in the running of the business, the owner along the line came to take 500 cedis out of the business. When he take it to, he didn't use it for business use, or he didn't use it to purchase something to be used by the business. He went to use it for his own personal something. So like paying of his child's school fees, or buying of food, or buying of fuel for his own car, which is not he is not using for the business, or he's not using the run of the business, his personal car. So when the owner does these things, it is referred to as drawings. Mind you, when the owner comes to take money from the business and uses it to do something in the name of the business, that one is not a drawing. A deduction can only be called a drawing when the owner uses it for something of personal use and not for business use. So business use is not drawings, but personal use is drawings. I hope this is clear. So we'll be continuing in the next video for the accounting equation itself. So stay tuned and watch the next video. Thank you.